Welcome back. From one auto company to another, we have Motherson Sumi Wiring, which is the next stock on our radar. The company posted a mixed set of numbers. It was a strong growth in revenues, but the stock is under pressure because the margins contracted by 290 basis points year on year because of some one-time costs. They had a startup cost of their new program at Bengaluru. They faced supply chain constraints, additional costs on freight and manpower. So let's find out more. Vivek Chand Sehgal, the chairman at Motherson Sumi Wiring, joins us now to discuss their Q2 performance. Mr. Sehgal, good morning and happy Diwali to you and your entire team at Motherson. Hope this is a great year for you, health and business-wise. Wanted to start by asking you about this margin pressure, right? In your presentation, you mentioned that these are one-time costs that you incurred. But do you think that there could be more, pressure on your margins? And for the second half of the year, is there a possibility that you could even go to single-digit margins for Motherson Wiring?
Thank you very much for having me. Wish you all a happy Diwali as well and all the blessings. I think the second quarter actually saw, because of the flurry of orders and the automotive market coming back, we needed two very urgent plants, one in Chennai, one in Bangalore. And then we had a couple of some local issues over there where the minimum wages has gone up radically and all that. And those kind of things are there. We have talked to the customers. Customers are very comfortable. They want the supplies, so they are not questioning. And these are in public domain. So I think this particular thing is better looked at if you see the half year numbers. That sort of averages out to this thing around. But these are one-offs, and I think the new negotiation that will take place very quickly will settle the matter for the next half. So I think the story of Rose will continue, and they will do much better than what they have done in the second quarter. But the revenue is heartening.
Yes. We'll come to that in a bit. Just a follow-up, in the conference call, you mentioned that the front-loaded costs for both labor and freight due to these new plants that you put up was about 30 crores, which is 1.6% of sales. Just wanted to understand, will there be any additional outsized costs on labor and freight as well as manpower in the second half of the year?
I think, Sonia, is going to get mitigated because these things are at the this thing of the OEM. And the OEM is very comfortable to reimburse that because he wants the supplies. Sometimes things happen very quickly, and the management is very quick to talk to the customers because there's a specified one-off customers, and take the advantage of a pre-approval from them. So I think this thing would not really affect so much. It'll get normalized very quickly.
Okay, it'll get normalized quickly. Now to the good part, right? You said that, the orders are coming in thick and fast. And you also mentioned that you're working to onboard more customers for high voltage electric vehicle wiring harnesses across 2, 3 and 4-wheelers. Tell us a little bit about that. How much is the order book now? How much has the kit value gone up? And what would this mean for your revenue trajectory in the full year?
See, the revenues we've crossed a figure of 1,800 crores for the quarter, and that augurs very well. And the demand is going to go up, but I don't want to sort of guess on numbers and all that. For us, it's very important that we supply exactly what the customer wants and the numbers. From the customer side, the kind of feeling that we are getting is if we can supply one more harness, one more set of harness, they are very, very, very happy and grateful. So I think in such an environment, we would leave the numbers to the people. They are buying left, right, and center. But I think there is an equal pressure for 2-wheelers, 4-wheelers, and 3-wheelers, etc., and trucks also. So I think it's going to get even better. than what it is just now.
So you may not want to give us a number, but it's already been a 30% growth, in excess of 30% actually in Q2. You think this is a run rate that you can maintain in the second half of the year as well, the growth rate?
I would be surprised if it's not 30%.
Okay, all right. What about raw material costs as a percentage of sales? That's fallen quite a bit. So, X of these one-off costs, it's operationally an improvement that you're seeing. 66.2% is the raw material cost as a percentage of sale. It was about, it's fallen in the quarter gone by. So, do you see some more improvement over there? And what is the expectation on what the margins could be?
So I think it's a volatile world that we live in. We are very grateful to our customers. Most of it is passed through. And either way, it works fine. And yet, the internal improvements that we are doing and all that, with 2 new plants in the south, it was very quick upgrading to a normal production factory that is going to be key. So I think our attention is going to be more on that. And raw material prices going up and down, we really don't know. People are saying there's a recession coming all over the world. That will augur well. The Japanese yen is at a historic low. So all these things will play out the way they do. We don't really speculate or something on that. Whatever we do is more on the production and the quality and the delivery. That's our focus area on this.
All right, Mr. Sehgal, thank you very much for that. I appreciate you joining in with that. By the way, I just want a quick point, Nigel. The market is at the day's high. Yes. It's back at the day's high. 18,133 is where we are at. So we've seen a sharp move up from about 940 onwards in the last 10 minutes, basically. And it's 123, 125 points higher that we are tracking now. So not giving up any of those gains that we started with and adding a little bit with about 45 minutes of trade behind us. Nigel.
Well, it's a really good-looking screen. One would have to say the first 30 minutes, any kind of minor dip that you're getting, that's being lapped up. So let's see where we end up. But otherwise, a solid start to trade. Well, let's focus on our next management, Data Patterns. They posted a very good set of numbers in the second quarter. The company clocked in a sharp improvement in revenues, which spiked up. The order intake as well was up close to around 3.5 times at around 470 crores. To understand more about the past quarter, the way ahead, we're joined by Mr. Rangarajan, the CMD of the company. Hi, Mr. Rangarajan. Good morning. Thanks so much for joining in, and season's greetings to you as well as your family and your entire team at Data Patterns. Well, thank you. First up, I would like to ask you about your revenue targets. I'm going through your presentation, and you're still guiding for a top-line growth of around 25 to 35% odd, with margins of around 40%. My question to you is, your first half of the year has been phenomenal, right? I mean, you're up by close to 60%. Why wouldn't you want to revise that number? Or are you being a little bit cautious, or you want to keep the surprise for quarter 3 and go ahead and revise that number?
See, the idea is to, try to even out quarter on quarter. We're trying to do that. Essentially, our business is last quarter sale is very heavy. So we're trying to even out to go with market expectations. So we're trying doing that. We're doing that reasonably well now. But yes, coming back to the second point of 25 to 30%, it's likely that we can increase that. But we will do this one at a time. Let us do this market correction on quarter to quarter first. Liquid growth the way we want. We've started somewhere. We are having an order book, which is about 830 odd crores. Yes. We expect additional about 300 crores order coming up in the next couple of quarters. So I think we are going there. So we will like to retain the maybe conservative growth plan, but let me deliver rather than talk much now.
Mr. Rangarajan, do you want to revise it at least to the upper end of the band instead of 25? Should we just not talk about 25 and talk about 35% itself? That's point number one. And also, how much will exports contribute? Because that's jumped up quite decently. And a couple of clarifications on exports. Is it better margin business?
No, export will be a slightly lower margin than what we do in India.
Okay.
Because we do development, of course. There is some value add, but it is not an offset export. We actually do our own product which is exported, so there is a better margin in that, some sense. It's not just manufacturing margin. But however, what we do here is a full system. There we do part of a system. So obviously the margins will be better when you do in India. And regarding export growth, I think we're doing about 10% export on our overall turnover on a yearly projection. So this may be higher in the first 2 quarters, but I think we'll retain about 10% on the year end export business. We are expecting some more export orders. We've quoted somewhere. We expect the contracts to come. Maybe we'll announce this in the next 1 or 2 months.
Okay, all right. And total order book of 1,000 crores with that 300 odd crores coming in the next couple of quarters. Good morning, Mr. Rangarajan. And on that guidance bit, so 35 to 40, is this the new way to look at things for 23? Although officially you said you'll do it when the time comes.
Yeah, we'll retain what we are saying.
Okay.
And let us see how it goes, because see, there are pressures on component availability. We are actually stocking more now to reduce the pressure on unexpected component delays. So there are a few still problems in the market. We need to iron them out. We are buying more. Let us see how we are able to deliver.
In the last quarter, you'd said that between production and development, you're getting more work in a given quarter, even longer term. I mean, it's more beneficial because then you're involved in the entire chain from development to actual manufacturing. What is the split in your revenues in this quarter? How much came from development? How much from manufacturing?
I think this time development revenue is more than manufacturing. We've got also order book is more development now than in production. We did about 34% in development and about 56% in production, and some 10% of service revenues also there.
Okay. By the way, just wanted to mention the market is now zooming away. So just take one look at what's happening on the screen. Wanted to get the Nifty up on board. 125 points higher for the Nifty. And many stocks are just charging ahead, specifically these platform companies. Very interesting. Yesterday, Nykaa had a big move on the upside. It's seeing some follow-on buying this morning, 3%. PB Fintech is up 3% and delivery is up over 9%. So there's huge moves seen in many of these platform companies. Even names like Blue Star, Aster DM, City Union Bank are all looking pretty good. But sir, just want to come back. Sorry, Mr. Rangarajan. Want to come back to your business. You were telling us about the growth triggers. In the satellite business, you've shown your interest as well. Any orders that you have, any visibility here, and what could the growth be?
No, we don't have very large orders in satellite. This is going to be what we're working on is expected order book. The future, I think, looks bright because space has been opened up in India, and companies like us who do ground-up development of the entire satellite, I think the business will have to happen. We still not got traction there in terms of business. I expect it to happen in the coming years. But more importantly, our growth plans is going to be because, the DEF Expo we had recently, we found that the response from end users, the services, is exceedingly good. Much, much different than what it was earlier. With the government push on trying to make more in India and 50% to be done in India,
okay.
I think the service sector, service officers and all of them, the chiefs are looking at companies like ours
Okay.
who do fundamental development to address the gap, the growing gap on products and capital equipment which they need.
Okay.
So this is an excellent thing. I think medium to long term, it's going to be an enormous growth option,
Right.
as long as it do more development in India.
Okay. All right, Mr. Rangarajan, very quickly, let's squeeze in a couple of questions. Then you've mentioned that your manufacturing capacity is going to be doubled from Q3 onwards. Put in a couple of numbers. What is it? What does the revenue potential go to?
See, we have put in infrastructure to cross 1,000 crores of revenue. It's possible.
Okay.
We are doubling or tripling some of the capacities, and it's almost another 3 months, the full system will be available to us. We've already started partially using the infrastructure.
Wow.
So I think we'll be able to address the growth plans as we have. And the more important thing is we have the infrastructure is creating is for end systems.
Okay.
We have a hangar where trucks can be brought inside, equipment
Yes.
can be assembled. From a box build to equipment build, the growth plan is going to be there. So we are actually ahead of time building infrastructure
Got it.
to look at future.
All right. So, Mr. Rangarajan, you'll have a capacity, a revenue potential of 1,000 crores is what you're saying, right? Potential, and then you can start ramping up. Got it. Very quickly, if you could tell us your cash conversion cycle, that still remains elevated, 367 days odd. Last year it was around 330 days. What is the steady state we should look at?
Now, we would look at coming it down, bringing it down to 270 to 300 days in the coming couple of years. But because of the availability of raw material, this sudden, we're not very sure when the component will come in. There is an accelerated procurement of components even for next year. We're buying components now and stocking it so that the delivery is not affected. We're still having quarter-to-quarter issues on delivery. What we should have delivered 2 quarters ahead, we still not delivered because of lack of available components. So the focus is trying to not really look at reducing inventory, but to build up inventory to deliver. Because we have an order book, an important thing is to deliver. That is why this bumpiness is coming up. It will get resolved in the coming years.
Okay. That 1,000 crores in potential revenues is a large number. It seems like a large number now because, I mean, we're talking about 1,000 crores in order book just a while back. And could you give us some indication, what is the timeline for something like this? How long could something like this take?
I can't give you a timeline, but what is important is that we have built up a large pipeline. Product development has happened. That is under either already accepted stage or already accepted or going through, trials. So if these gets converted, the size of pipeline we created is a few thousand crores. So that is the reason we need to create infrastructure. And also now that MOD business is directly open to us, we started bidding on MOD business directly, not necessarily only go through DRDO. So there is a mix of opportunities which is coming up. And we need to be prepared to address the opportunities. That is why infrastructure is being created.
Okay. All right. So we'll leave it at that. Thanks a lot for joining in and all the best for the year to come. That's the word coming in from data patterns. The market is doing fine. In fact, now the Bank Nifty is up 320 points, looking pretty good. Let's take a quick break on that note. On the other side, Mitesh Thakkar will tell us about some technical trades and we'll give you a list of buzzing stocks as well. So don't go anywhere.
Okay, welcome back. 130 points now at the day's high, practically 18,140. Mitesh Thakkar is with us to run us through what he would like you to do in terms of specific trading ideas. Now, Mitesh, it was a gap up and market seems to be moving a little higher. What would you do?
So Prashant, first a word on the Bank Nifty. I think, the Bank Nifty has managed to get past 41,500. That was an important pivot on the hourly and the 2-hourly chart. So I think as long as we are above that, I think traders should maintain long positions. Even Bank Nifty, if somebody wants to buy, take a 200-point stop loss from here and look for targets of around 42,250 on the upside. Having said that, a couple of stocks are breaking out. NTPC is clearly one of the top gainers today. That's a buy with a stop at about 175.5 for targets of 188 to about 189. And the other one which I like is Petronet. That's a buy with a stop below levels of 205 for targets of 215.
Okay, all right. Mitesh, thanks a lot for that. Let's go across to Manisha now to find out what's happening in the world of commodities. Manisha, over to you.
Sonia, thank you so much for that. Well, I'm looking at the metals as a sector and I'm looking at zinc specifically because the prices are trading at a 20-month lows right now and we have seen prices continue to decline. Overnight was nearly 4% of a cut for the month of October. We are down by nearly 10% for the zinc prices and this year until now we are down by nearly 24%. If you look at the high and low for zinc for this year itself, we did see a 16-year highs of around 4,498. It's almost $4,500 there, but the low has been at around 2,678, which is the current price as well. So very sharp decline from the highs and we are down by nearly 40% in case of zinc from the highs. And this is even as the smelter shutdowns continue due to high energy costs and margin squeeze, especially coming in from Europe. There have been reports on how Glencore's 2 plants, one in Italy and one in Germany, are shut right now because of care and maintenance is how they put it as. And the other plant is from Nyrstar at Netherlands, which also is shut. And in addition to that, there are various other plants, smelters, production capacities, which are being re-looked into. And there are companies which are adjusting their run rates for many of these. And zinc prices have continued to decline even as Russia and Ukraine are at war. There are Chinese energy restrictions on production and smelting, and the Europe production curbs have just about continued. The reason that you have seen the zinc prices continue to decline, one, the demand is on the weaker side from Europe, and the zinc ingots output is expected to rebound in the month of November to as high as 540,000. So even with the curbs and production shuts, we have seen zinc zinc prices decline. If you see all of these production shuts coming back in case of the month of November, the markets are anticipating that you will look at further decline in zinc prices. The strength in US dollar, the weak Chinese data, the weak Chinese demand, all of that is yet another reason that you have seen pressure come in for the zinc prices. The other reason is that zinc is used for galvanizing in steel, and the steel prices and the steel demand itself has been declining. So when you look at the steel prices, we're trading at 2.5-year lows. When you look at the iron ore prices, we are trading at nearly a 20-month lows onto that one as well. Iron ore actually is headed for a biggest monthly decline in 2 years when you look at the month of October. This is the kind of price decline that we have seen for the month of October, where you have seen the steel prices decline 13%, iron ore 19%, and zinc 10%. Zinc actually is leading the decline when you look at the non-ferrous metals. So within the base metal prices, the kind of month October has been for copper, aluminum, as nickel is quite flat to marginally on the weaker side. With zinc falling 10% in relation to this, it clearly has been an underperformer for the month of October, and the markets do believe that November is going to turn out no different.
Okay, all right. Thanks a lot for that, Manisha. Well, let's focus on the commodity space. Let's start our Steel. It's reacting to its numbers every week set. Well, yesterday I had a brief chat with the management, Mr. Narendran. He gave us some comments on coking coal cost, what is the relief they can receive in the coming quarter, and also gave us some bit of an outlook on the European business for the second half of the year.
Most of the coking coal we used was coking coal that we had bought in the previous quarter. So we really did not get any benefit on an average. Of course, the coking coal consumption cost in September was lower than July, but July and August it was actually moving upwards rather than downwards. So we will start seeing the benefit in Q3. Europe may be about $100, India would be about $90. The second half for Europe will not be as good as the first half. That is clear, simply because the rising energy costs would have an impact, though over the last 3 weeks, as you would know, the gas prices have dropped very significantly. So maybe Q4 will not be as bad as we thought it would be. No, not negative. It won't be negative, but let's see where it is.
All right, let's briefly run you through the numbers then. Consolidated basis, there was a bit of a miss. India business, there was a big miss. It came in at sub 9,000 rupees. We were working in the vicinity of around 10 to around 11,000 rupees. Europe was in line. The problem is what happens going ahead. And the debt increased by close to around 17,000 crores because of the NINL acquisition, capex, as well as the paid out dividend. Now, as we heard the management, they said that cost will be lower. Coking coal cost in particular will be lower in the coming quarter. For India by $90 per ton, in Europe by around $100 per ton. Also, we need to highlight a couple of brokerages, and CLSA, they have downgraded the stock and they've slashed their target price to around 90 rupees from around 110 rupees. They've lowered the profitability basically for the next few years by around 18 to around 25%, predominantly for the European business. They've commented on both the businesses. So on India business, they're expecting margins to improve, though they highlight that there is a risk to India steel prices because Indian steel prices are at a sharp premium in comparison to international prices and imported steel on the whole. For Europe, they're saying that they see meaningful downside to the profitability, spreads will compress, and also we'll see pressure on contract pricing. So that's their rationale out there. But Sonia, tell us about auto sales. Escorts, how are the numbers?
So, you know, I'm tracking Escorts this morning. The numbers just came out a while back and they're looking good, both month on month as well as on a year-on-year basis. The numbers are strong. Total sales growth of 7.2% year-on-year at 14,492 units. And it's a growth of 18% compared to what we saw in the month of September. Domestic sales have also grown about 8.6%. They get, you know, a large chunk of their business from the domestic market. And the commentary is good. The management says that the festive demand was good, led by an above normal monsoon and higher water reservoir levels. For the coming Rabi season, all macroeconomic factors remain favourable for the industry. The only point of concern is the overhang of unabsorbed commodity inflation, which could perhaps impact their earnings in the quarter to come. Now, if you look at the trend as well, right, from an average of 5,000 and 6,000 units, the sales have gone up all the way to 12,000 to 15,000. And the last time they hit these sales was in pre-COVID levels. So if you look at the whole year, in January, it was somewhere around 9,000-10,000 units. It fell to 8,000 units, then to 5,000-6,000, and now back to 14,000-15,000 units. So this is the highest that we've seen, at least in 2022 for Escorts, and perhaps this is something that the street will like. Now, why is the stock under pressure? That's because the stock is perhaps seeing profit taking after a very strong run that it has had. It's gone from 1,500 all the way to 2,000 in less than a span of 6 months. So perhaps just some profit taking is what you're seeing today. Otherwise, numbers are looking very good for Escorts Kubota. But let's find out more about Timken. I think the story is similar over there. It's down 3%. Profit taking perhaps because the numbers were not too bad and the stock has done very well. Vahishta is here to tell us the earnings fine print. Vahishta.
Hi Sonia, thanks for that. You're absolutely right. Timken India actually did have some good set of numbers coming in yesterday. The revenues were up 25%. The EBITDA was also up 6%. PAT was also up 24%. However, there's been some miss on the margins, which is coming at 18.8% versus 22.2%. Seems like this is what has disappointed the streets, or probably could also be a profit taking.
Okay, all right, Vaista, thanks a lot for that. Well, markets, no worries whatsoever. That FI buy number yesterday, coupled with put writing, that's what gave some confidence. And the market's just trending higher as we speak. And a couple of stocks to highlight. Yesterday, it was the day for Nykaa. Remember, the street has been a little bit skeptical because there could be fresh supply that comes in, potentially, since the unlock, the lock-in period expires. Nykaa is up another 6.6%. Delivery is up close to around 8%. Also, it seems some of these new age themes, they're seeing some bit of buying or bottom fishing. I'm not too sure. But the fear is that there could be big supply that will hit. For the time being, the street seems to be buying into that weakness that we've seen in the last few days or so. Well, let's slip into a short break. But on the other side, Lata will connect with Mr. R. Shankar Raman of L&T to discuss the past quarter.
Well, if there is any stock you can discuss for the economy as a whole, it has to be Larsen & Toubro. Well, it's on our radar because of the Q2 numbers, a great set of numbers actually. On all parameters, it saw an encouraging order book. That was the biggest thing, the order inflow, and right now has the highest ever order book that it ever had, 3.7 lakh crore. Good to hear that number. Maintains a guidance of 12 to 15% in the order book booking. The stock has drawn all-round praise, actually. There have been some brokerages that have even increased their target price. I think Morgan Stanley is the one that has raised the EPS target for FY 23-24 by about 1 to 8%. So an all-round buy from many brokerages. R. Shankar Raman, the whole-time director and CFO at L&T, joins us now. Mr. Shankar Raman, thank you very much for joining us. Well, I'll start actually with the Hyderabad Metro and the road assets, because that's got the investor community very excited. Can you give us any timeline for the Hyderabad Metro? After all, the passenger traffic is improving.
Actually, the timeline is ticking. We have, in the last 3 months, managed to obtain the government's permission for interest-free long-term loan of 3,000 crores. This has been discussed for almost close to a year with the government now. And this quarter saw us actually get that government order, which is a very significant development for the project, because this 3,000 crores will go to reduce the debt of the project. Just to step back, I think the project is actually a good project. The capital structure was not in line with the ridership that we have been experiencing. And obviously, the capital structure never took into account there's going to be a COVID break.
Yeah.
So what we are now attempting to do is to ensure that we get the capital structure right for the ridership that we are currently experiencing.
Okay.
13,000 crores of debt when 4.5 lakh people are traveling on the train every day is a little unsustainable. We need to get it down to somewhere around 8,000 odd crores of debt. And this 3,000 crores will help us get there. We've also got the government permission in the last quarter to be able to monetize some of the land parcels that are associated with the Hyderabad Metro project.
Yeah.
This again is a big win according to us from a strategic point of view,
Yeah.
because this will help us again reduce the debt.
I'm sorry to be interrupting, because I'm trying to pack in more in this interview. This much I got from your conference call, that you are planning to sell land parcels, and of course you've got the 3,000 crore from the government as well. But that will leave us still 2,000 crores more to get to your 8,000 crore target. By when does that happen? Will these land parcels be sold in the current financial year? You have any other plans to get to 8,000 in this FY?
A portion of the land parcel will be sold in the current year, but this is going to take at least 12 to 18 months for completing the restructuring that we are attempting to do. You can say that right from as we speak now, till the end of the year, there will be some portions of action, and then it will continue on to the next year.
You will be factoring in a rise in ridership as well, isn't it?
Yeah, I think that has been encouraging. Almost 20,000 people every month incrementally are beginning to ride. We hope that the IT crowd returns back to office to work because that's going to be a major needle mover insofar as the ridership is concerned. I think this asset, and since it is transformative mode of travel, Hyderabad will have to get used to using the metro. It's getting there. I think it will take in another 2 years' time, we should see 6 to 7 lakhs people riding every day on this.
Okay, now let me come to the road assets, Mr. Shankaraman. What is the amount you are looking at?
See, the assets are in form of the stake in IDPL, because the IDPL is a subsidiary that is actually holding all these assets. Every asset is unique, so it has its own discrete cash flow. Being a very price-sensitive information, before the document is inked, I am not authorized to announce the value. But suffice to say that we are getting a fair value for the assets that we are exiting. We are into the documentation discussion phase, so I expect by the time this calendar year is out, we would have inked the document. Like anything else, I think we need a hell of a lot of approvals from various authorities. So that is going to take 3 to 4 months for getting the various NOCs from all the concerned stakeholders. So the consummation of the deal, we are targeting to do it by March 23. Maybe it will slip a month beyond that, depending on how rapidly the approvals are obtained. But step one, milestone one, would be to ink the document by end of this year.
Okay. So the ROE impact will be already definitely there in FY24.
Oh, most certainly. Most certainly.
Okay. Oh, that's good to hear, because after all, the pricing is already adjusted in the stock market to the FY24 ROE. And that's why I was trying to get a number. I guess we will get a number closer to March, right?
Yes, you will.
Okay. Now we come to the margin. I mean, that was the only sore point. You had all-round praise for every aspect. Order booking, execution, etc. But margin, yes, fell short by about a percentage point. There are encouraging signs, as you pointed out in the conference call, that commodity prices are falling. Perhaps even execution speed will improve. Do you think you'll only get to flat, or is there a likelihood of an upside surprise?
See, at the beginning of the year, we told ourselves that we need to have 30 basis points improvement over the reported margin of the previous year, which was 9.2%. So we were shooting at 9.5%. We didn't anticipate the supply chain to stay broken and the war to continue the way it has been so far. So to that extent, I think there has been some headwinds in terms of the supply chain getting back to order. But having said that, most of the costs that we are booking as we progress onto the jobs now are procurement contracted during the last 12 to 18 months, especially the long lead items. So given that we are consuming the high cost material that we have procured during the inflationary phase, the benefit of procurement at current prices and hopefully going beyond the current levels if the prices continue to soften some more, the benefit of those would actually play out in the margins in FY24. So what you will see in FY23 is possibly the growth that we anticipated over the previous year may prove to be a challenge. We have not given up it. We're doing everything possible within our means to make sure that we're able to get all aspects of execution done well so that we can do some amount of recoupment. But the fact is, I think the war and the supply chain disruptions have actually put a spoke in the wheel.
Oh, yes, it's put a spoke in the wheel in every aspect of the macro and the micro, isn't it? Let me come now to the order book itself, the best part of all that you all said yesterday. Looks like your sources of orders are central government, central PSUs, state government, private sector, and international orders. Now, which of these five are showing more traction in the second half? We already know that central government and PSUs did better, the Gulf countries did better. But if you have to guide us for the second half, which group is likely to give you best?
Actually, this configuration is the configuration that we anyway are targeting. So all our order inflow has to come from this configuration.
Yeah.
Just statistically speaking, out of the 21 odd lakh crore that has been set aside between the state center and the PSUs, roughly about 7 lakh crore is the center's share. 30% of that has been consumed in H1. That still leaves 70% to go.
Okay.
The states have been a bit of a laggard. The states have consumed about 20% of what their budgetary plan was. So always the aspect that we need to watch out is how far states are equipped to carry through their plan. And to the extent of shortfall, that could happen because this we've been seeing from time to time, that states do end up shorter than what they plan at the beginning of the year. The robust order seen in the Middle East is actually proving to be a fairly good compensating factor.
Okay.
The energy crisis that the world is facing has had some upsides in terms of the investment momentum and interest in the Middle East. Not only is Middle East investing in energy assets, it is also investing in assets which are energy intensive in its application. So we find that fertilizers, refinery expansion, as well as the minerals and metals sector in the Middle East doing well. Okay. Middle East wants to also broad base its economy and attract more people for so many other things other than purchasing oil or gas. So the infrastructure build out that is happening in Middle East, Saudi Arabia in particular, because that country is beginning to now gather a lot of pace in terms of all-round investment. We see opportunities in renewable energy there. We see opportunities in power transmission there. We see opportunities in water there. So all of and some of these countries are also building new cities.
Okay.
So all of this gives us a good counterbalance to possible shortfall that could happen in the state spend in the domestic markets.
So I'm not surprised, sir. All our money is going towards the Middle East. Every oil, crude importing country. So they are bound to be. At least there is a positive for you in terms of the order book. I want to know about private capex cycle in India.
I think let me broad-base private capital investments. Very interestingly, in this half year, actually, the share of private sector capex is 37%, and I have not seen this in the past 8-9 quarters.
Oh.
The percentage used to be around 19-20%, and now that's moved to 37%. Largely on the back of private sector orders that we have received in solar space in the Middle East, as well as in the domestic market, a large expansion in the steel sector.
May I interrupt? May I interrupt 1 minute? I wanted to know about Indian private sector.
I know the steel that I'm talking about is Indian private sector.
Yeah.
And we find that investments in data center is gathering pace. The long format IKEA is investing more in opening more centers, and we have won some orders so far, and that seems to be a prospect.
Okay.
Automobile industry, paint industry, cement industry, all of them are in discussions for brownfield expansion. I have not seen so much of greenfield expansion other than the recent announcements that are made on some areas like green energy and aerospace. Much of these expansions that we are currently discussing on our brownfield expansion, existing customers at some point in time. So we are confident that these incremental capex will ultimately at the end of the year have a bearing on the private capex coming out much better than what they were, say, 1 year before.
So how confidently can I, as a macro student, say that the capex cycle has started?
I think it's just a question of our own mindset when we look at these, because the balance sheets of private sector have got repaired big time. I think many of them are still the memories of a large capacity not supported by market is still fresh in many minds. So boards are not going to be falling over each other to make sure that the approvals are in place. But there is an opportunity in all this situation. India seems to be better placed than most of the global economies. So that being the case, and the push that the government is giving for increasing domestic manufacturing augurs well for us to stay positive.
Okay, that is still staying positive. I wish you would talk about positive in the past tense. augurs well is what I have heard for quite some time now. In any case, out of time, Mr. Shankaraman, it's a pleasure speaking with you. Many congratulations. And one number, can you guess your ROE next year? Range?
Yeah, we are targeting to be at least 1% higher than what we were last year.
Okay.
And I think incrementally every year till 26, you will see this 1 to 1.5% increase.
Oh, that's a great number by way of guidance. Thank you very much indeed for joining us. We have to wrap up on Bazaar on that high note. Trading ideas lined up for you on Chartbusters.